This is the only indicator that the god of investment used to measure how expensive is the US stock market relative to the economy that supports it. And in April 2026, this indicator has reached 232.6%. Not a forecast, not a countdown clock, just a ratio that says the total value of publicly traded US stocks is now more than 2.3 times the entire annual output of the US economy. The goal here is not to predict a crash. The goal is to understand what kind of future must go right for prices to stay where they are. The Buffett indicator is simple by design. You take total US stock market capitalization, which reflects what investors are willing to pay today for future corporate cash flows, and you divide it by US GDP, which measures what the economy actually produces this year inside US borders. Intuitively, it is like comparing the price of a farm to how much food that farm produces in a year. Prices can exceed output for long periods, but when the gap becomes extreme, small disappointments start to matter a lot. A reading of 232.6% means the market is valued at roughly 2.3 times the economy's annual output. That is higher than the peak of the dot-com bubble, higher than the 2021 everything bubble. Markets have been this far above their economic base only a handful of times, and those episodes did not end quietly. Sometimes they ended with crashes, sometimes with long stretches where prices went nowhere while the economy slowly caught up. But the common feature was normalization. That normalization is mechanical, not mystical. The ratio can fall in three ways. 1. Market prices fall while GDP stays roughly the same. 2. GDP grows faster than market prices while stocks go sideways. 3. Some combination of the two. The math matters here. If GDP were flat and the ratio moved from 232% back toward 150%, market capitalization would need to fall by roughly 35%. To get closer to 130%, the drop is over 40%. These are not predictions, they are just arithmetic, and they explain why downside discussions often cluster around the same numbers. So why is the ratio this high in 2026? The first force is the AI productivity premium. Markets are pricing a world where AI allows higher output per worker, scalable profits, and earnings growth that partially decouples from domestic GDP. If software and models can be replicated at near zero cost, profits can rise faster than measured economic output. That story is not absurd, but it carries risk. History is full of technologies that were transformative in reality and still overvalued in markets because timelines were pulled forward too aggressively. The second force is the legacy of TINA, there is no alternative, combined with residual liquidity. Even with policy rates around 3.5 to 3.75%, many investors still view bonds as unattractive after inflation. Real estate faces its own problems with cap rates under pressure. Large pools of capital have to allocate somewhere. High equity prices do not require euphoria, they only require a world where alternatives look worse. The third force is the globalization mismatch built into the indicator itself. GDP is domestic, corporate revenues are not. More than 40% of S&P 500 revenues come outside the United States. As US multinationals sell software, services, and platforms globally, the numerator increasingly reflects claims on global cash flows, while the denominator remains tied to US borders. This creates a structural upward bias compared to earlier decades. The key question is not whether this matters, but whether it is enough to justify 232%. Another layer sits beneath all of this: corporate profits. In 2026, profits are around 12% of GDP versus a long-run norm closer to 7 or 8%. Valuations ultimately rest on expected profits. If profit share stays elevated, high market values can appear justified. If profit share falls even without a recession, the math gets uncomfortable quickly. A move from 12% back to 8% is a 1/3 decline in profit flow. Even if valuation multiples stayed the same, market values would need to reset lower. And historically, margins and multiples rarely fall separately. There are good arguments for why margins might stay high. Platform effects, scale economies in software, data advantages, and winner-take-most dynamics are real. But there are also reasons margins might compress anyway. AI lowers barriers to entry. Regulation and antitrust pressure are not static. Customers push back on pricing. Labor share can rebound. None of these require catastrophe. They only require competition to work again. At this point, critics often say the Buffett indicator is obsolete. Asset-light companies don't need factories, so GDP understates value. Intangibles like brand and data are poorly measured. Low real rates justify higher valuations. All of that is partly true. These arguments explain why the ratio can be higher than in the past. They do not explain why it can be infinite. As the number rises, the burden of proof rises with it. This is where behavior matters. In April 2026, Berkshire Hathaway is sitting on roughly $190 billion in cash. That doesn't mean a crash is imminent. Deal flow is lumpy, and Berkshire's size makes opportunities scarce. But it's a signal. When a valuation-disciplined buyer with permanent capital struggles to deploy cash, it suggests opportunity sets are thin. It's not prophecy, it's context. So what happens next? There are two broad paths. The first is a soft melt-up, or more accurately, stagnation. GDP grows, nominally and maybe even decently. Earnings hold up, helped by AI efficiencies. Market prices go sideways for years. Over time, the ratio drifts down as the denominator catches up. Investors pay for past gains with time instead of losses. The second path is a sharper mean reversion, not because the indicator flashes red, but because something changes discount rates or confidence, a geopolitical shock, a jump in unemployment, a credit event, an inflation surprise that pushes real rates higher. When valuations are extreme and positioning is crowded, small shocks can trigger large repricing. Multiples compress. Passive flows amplify moves. 30 to 40% declines suddenly stop sounding abstract because that's what the math requires. The right way to think about the Buffett indicator is not as a crystal ball, but as a fragility meter. It answers a different question. How much perfection is already priced in? At 232%, prices are assuming high profit shares persist. Global dominance continues. Discount rates stay friendly, and AI delivers earnings growth on schedule. The higher the ratio, the less room there is for error. Disappointment matters more than disaster. If you want to watch whether this alarm quiets or grows louder, focus on a few things: profit share and margins, real rates and equity risk premiums, market breadth versus concentration, whether earnings growth is coming from cash flow or just multiple expansion, and credit conditions, because liquidity has the habit of exposing weak points first. The 232% alarm is not telling you what will happen. It's telling you what must go right for prices to hold. But here's the catch. We haven't even talked about the hidden risk that could flip this script overnight. Next video, we're breaking down the one factor the Buffett indicator misses, and it's the reason even seasoned investors are on edge. Don't miss it.